We're going to calculate the stock price for Kohl's. First thing we need is the market cap, which is 3.2 billion. And then we need the stock price at 20.64. And now we have the shares outstanding of 155 million. The way we calculate that is the market cap divided by the stock price is the shares outstanding. And we're going to calculate the future free cash flow of the company and discount that number back to today. And then we have a value for the entire company. And then divide that value by 155 million and see what the stock price is. That's what we call the intrinsic stock price. And we're going to compare it to the actual stock price. And this is how you value a company. You use future free cash flows. Now let's get the actual free cash flows. We'll go to the financials section in Yahoo. We'll go to cash flows and get free cash flow. And put that into our model. And next we need net income, and that's on the income statement. And that's the profit and loss for a company. And as you're doing this, you should be looking at the numbers as well to see how the numbers move over time. Last, we need revenue, especially if there's some big outliers that will affect the valuation and make it really difficult to get an accurate reading. So there's a lot of kind of assumptions and intuition when doing models. So you have to kind of use some judgment as well, which can make it tricky, but the more you do of it, the more you learn. Now we need to look at the capital structure of Kohl's to figure out the discount rate. We need to apply it to future cash flows. And the interest expense on the income statement is 207 million. That's the interest Kohl's pays on its debt. Now let's see how much debt they have. We'll go to the balance sheet and then the liability section. No current debt. Long-term debt of 1.9 billion. So that's debt due after 1 year. They pay 11% interest on the debt. That's really high. I'm surprised they pay such a high interest rate. But interest payments are tax deductible, so let's find out the effective tax rate. Go back to the income statement, the income before tax of 900 million, the income tax of 200 million, and the effective tax rate is 23%. So the cost of debt is 8.55%. And 37% of the capital structure is debt, which is a little on the high side, but not too bad. Let's see the beta, because we want to find out their cost of equity. And the beta is 1.75, a little high as well. That's probably why they pay high interest. So beta is the volatility of the stock. It's how it moves with the market. So this stock moves 1.75 times the market. And the higher the beta, the higher the risk. So as you can see, cost of equity is 16%, cost of debt is 8.5%. And equity has a higher return than debt because equity is riskier. In the event of a default, debt holders are paid before equity holders. So debt holders take on less risk and therefore get a less return than equity holders. Now when you combine the two numbers together, you get the WACC, the weighted average cost of capital, and that's a discount rate we need to apply to the future cash flows. So we calculated future free cash flows in 4 years, and then we did a terminal value, which is all the years past year 4. Then we discounted those numbers back to today, and we get a value of the company of $8 billion. And when we divide that by 155 million shares, we get a stock price of $53. So as you can see, Kohl's is trading at a discount. It's trading at a 61% discount, so we consider this a buy. Let's see how Kohl's is trading closer to intrinsic value earlier this year. And it's really dropped a lot. So stocks can trade higher or lower than intrinsic value. The stock price is based on supply and demand of the market. If more people want to buy a stock, the price gets bid up. And if more people want to sell a stock, the price gets pushed down. So it really doesn't matter what something is worth. It's what people are willing to pay. That's the same thing with stocks. Even if a company is worth a certain amount of money, but people aren't willing to pay for that, it doesn't mean the stock price is going to stay that. So everyone has their own opinions on the value of a stock. This is my model and it's my opinion. So thanks for watching.